It's lovely to meet you all. Some of you I know because I actually moved into the DTAS office a week ago, and that was really to do with filing cabinet issues in my previous office. So basically, the Scottish Communities Finance Limited, or I'm going to start using SCF, it's a lot briefer. We are a community benefit society, and like all community benefit society, we're registered with the FCA. And we actually work with third sector organisations to raise affordable and patient, by which I mean money that doesn't have to be immediately repaid, repayable finance from within the communities that the organisations are situated within, I suppose is the best way to. So it's all the third sector, not just development trust and not just any particular type of organisation. I'm going to need my glasses for this. This is where it gets complicated because if it's too near, I don't need my glasses. Okay, so democratic finance. So what do we mean? This is the term that I use for kind of what community shares, community bonds, crowdfunding, this kind of overarching name that is applied. It's actually, the explanation is in the name. So democratic in the sense everybody gets involved, and obviously finance in the sense of money. So it's where your money is sourced from many people in a community, rather than going to a bank or a building society or a social investment organization. You cut out what is known, they're kind of like the middlemen. So you're cutting that out. And by cutting them out, what you're doing is making your money more affordable. Because I suppose what happens at the moment is that if you go to a social investment provider, any of them across the UK, they themselves have purchased their money. So they've already paid for money, and then they have their own costs. And then you go to them and they take in security and they look at the due diligence, and then they give you a price that they will lend you the money at. So there's already a number of costs that have been incurred before they get down to your organization. So what the idea behind democratic finance allows you to do is actually go out to your community and say, invest in us directly, albeit perhaps through a platform, but essentially invest in us directly. And in return, we'll do great things in your community and we will give you a financial return, which is usually at this moment in time, a relatively affordable option for organizations, because really your only competition is banks or ISAs. And at the moment you're getting 0.025% or something. So if you're able to offer above that as an organization, then you're buying money very, very cheaply. So one of the benefits of democratic finance, well, it creates social capital. We know that because it links the investor to the community. And if I was an investor, and I have been in a number of community shares, then you use their products because you don't want it to collapse for lack of customers. So you become immediately a customer. So it locks in your customer base and it creates a new customer base. So I mightn't have used it before. Now I'm an investor, so I'm going to start using it now. It provides patient, as I said, long-term, affordable finance to organizations. We can discuss that later on. For me, the important thing, it encourages community to be agents of change. We hear a lot about how communities can do things themselves, but actually by not just taking control of assets, but actually putting your money locally and investing it locally, you can generate and multiply that change. It establishes what we term local citizen investors. And a citizen investor isn't a technical term. It's actually a term that just comes to define somebody who's interested in their community and is interested in investing at that level, rather than a high net worth individual investor or other types of investors. It's meant to capture, I'm interested in what's happening within my community, essentially. And of course, it keeps money circulating around communities. So I invest the first time, I get money back with a bit of interest. Somebody else, I invest the second time, and it doesn't flow out of the community. And I suppose, so what do we mean by community? I mean, I know for development trust, it tends to be geography and place, although not exclusively. I appreciate that, but that has become the norm. But it can just as in the case of SCF, it can just as easily be memberships and associations. So we work with sports clubs, for example, and they have a wider membership and they have players and various associations. It can be your customers or your clients. So, you know, I'm currently doing a bond offer and they have a number of people, customers that buy their products, and they will go out and they will be offered an opportunity to invest. And actually, Ecotricity started in this way. It actually went out to its people that used its services and asked it to invest. And they also used a bond model. It can be your stakeholders. There's no reason why your staff. There's no reason why, you know, in the case of a whiskey bond, people live in other parts of the world. They're interested in whiskey. They're interested in your community. So it can be a much broader concept of community. In most cases, it's actually a mixture of all of those. It can be 3 of those. It can be 2 of those, because even if you're geographical, you obviously will still have maybe customers or clients locally. And of course, it can be suppliers. So provided it's made very clear that that does not give them any kind of competitive advantage when it comes to supplying their products. So that's what my understanding of community is.
So can you see Toby and I now?
You just so that you can see your chin more than that's better.
I love the chin.
That's better. Nice chin, but that's good.
Okay.
Okay, morning everybody. So session today is going to focus on 3 key things. Firstly, crowdfunding, which I'll talk about next, and then Morgan's going to say about a bit about community shares, and finally Pauline's going to talk about community bonds. All very closely related. I think you could say that shares and bonds both fall under the umbrella of crowdfunding. And this next slide, I mean, I imagine everybody now is familiar with the term crowdfunding. I think it's something that's existed in various forms for a long time, but it's kind of been rebadged because the internet has made it so much easier to go out to a crowd of people and get small sums of money from various people to add up to a total that can do something useful. What people might not realize is that there's 4 kind of main categories of fundraising, crowdfunding, that are all slightly different. So the top 2 there are probably the 2 that people are most familiar with. First, we've got donations crowdfunding, which is where people support a campaign purely because they believe in the cause, and they don't get anything back other than, you know, other than realizing that they've done something useful. Rewards crowdfunding is probably the most popular type. That's where you get something, a physical product or a service in return. In some cases, that's merchandise, a tote bag, or a stamp or something. In other cases, it's essentially pre-ordering a product, and it's quite often used to launch new products. So people might know about Kickstarter, Indiegogo, those sort of ones. They're quite often used to launch new tech. That's kind of a prototype stage. The bottom 2 there, maybe a little bit less familiar for people. So firstly, we've got debt crowdfunding, which is essentially where people are each offering small loans to an organization. It's sometimes called peer-to-peer lending, usually with financial returns on that. And those are not in any way linked to the performance of the business. So the business is taken on debt, it owes those people that money back. And it's usually a fairly short payback term of a few years at most, with interest tied to it. Equity crowdfunding, very similar, but people are actually buying a stake in the enterprise, usually shares, and that is tied to the performance of the business. So whether they get money back depends on how the business performs, much like having shares in a company.
Can I just ask the debt crowdfunding? What's the platform to make that happen?
There's various platforms. I think debt crowdfunding, there's one called CSS that gets used a lot. There's one called Rate Setter that I think you can do debt crowdfunding on. There's one that the government manages. I can't remember the name of just now, but I can find out for you. But yeah, so that's kind of leads into the next bit, which is that the top 2 there, donations and rewards crowdfunding, are pretty much entirely unregulated in the UK. I think especially donations crowdfunding, you could go off for 5 minutes and set up a crowdfunding campaign for a charity or something that you're working with. It's very simple and straightforward. Rewards crowdfunding, also very straightforward. You do need to be mindful of maybe trading standards and that sort of thing if you're selling products, but otherwise fairly simple to do. The bottom two are very tightly regulated and they have to abide by financial promotions regulations, which means that you have to prepare a proper investment prospectus. You would usually have to work with a registered financial advisor. It's quite costly and time consuming, and for most community groups it's a prohibitive expense and time that would take. So community shares exist because the organisations that we work with, community benefit societies, are exempt from a lot of that regulation, and it means that it's kind of simpler for community groups to set up and run that way.
So the equity crowdfunding is effectively the same model as community shares. but
Kind of.
different regulations.
Kind of, yeah. So community shares kind of sits in the grey space almost. There is equity crowdfunding, but it's kind of distinct from other forms of equity crowdfunding because of those different regulations. So I've got one case study to look at. This is a case that Community Shares Scotland supported last year with a crowdfunding campaign. They previously issued community shares kind of in the early years of the CSS programme. I think they raised 10,000 in shares, 30,000 in community shares, and they've kind of come back. They wanted to expand a little bit, and they were running a share offer to do that. I think there's a lot that they did well in this case. I think they took the time to plan the campaign, and they spoke to us. They kind of thought about their marketing. They thought about who they were going to approach. They had a good range of rewards available, kind of starting at very low levels of about £10, working up to about £1,000. Some of those were clearly very attractive. I think the one that was about £300 was oversubscribed because it was a kind of personalised baking workshop. So they were quite successful in that sense. I think also a lot of learning from that one for them, particularly that they didn't have the people power to really capitalise on the campaign. I think a lot of the work fell to one kind of fairly junior marketing person who didn't feel they had the authority to kind of do a lot of things. And I think good successful crowdfunding campaigns really need a team behind them. We have seen ones that have been successful where they've just had one really incredibly driven figurehead who's done it all, but I think usually you want more than one person. So I think whenever we get a development trust on board looking at this, I'm always slightly concerned that it's a staff member who's doing all the work. I like to see a board involved, and I like to see that the directors are actually going to take on some of the work as well. This one was good because it tied in with a kind of media event. So the society had been nominated for an award and had kind of coverage on the back of that, and they managed to tie the campaign in nicely with that, and I think that gave them a bit of a springboard. So this was kind of a pilot for CSS and the support that we offer, and we're continuing to kind of look at how we can better support particularly DTAS members to do crowdfunding campaigns of this sort of scale. So we're very happy to chat to any groups that are interested in it.
Thanks, Toby. Any more questions in the room about crowdfunding or online?
If you had to position Rudolph in this crowdfunding model, where would you put them?
Yeah,
And
they're a
what
perfect
rewards?
example of equity crowdfunding.
They're both actually,
Right.
because they do give rewards to the investors.
Yeah, very true. Yeah, you do get combinations of the two quite often. So for example, Flowers to the People were mostly rewards-based crowdfunding, but they did have an option to just donate £10, I think, which is very common. And Brewdog, a good example where equity crowdfunding is also backed by rewards, and particularly where you've got people putting smaller sums into the equity, where they're maybe not making much in the equity. Probably the main draw for those people is discounts in the bar, free beers, that sort of thing. So it's quite common to mix of more than one type.
Can I ask about fees? So you guys, your service is free to support the groups, and then is this the standard fees like the crowdfunding? The platform will take a cut.
Yeah, absolutely. Again, it varies from type to type. So if you look at the top two there, they tend to carry the lower fees. In many cases, donations crowdfunding is completely free, particularly if you're a charity. There's a lot of platforms that do fee-free crowdfunding for charities. Rewards crowdfunding very variable. It kind of depends on how much you raise, I think. And there's a lot of different platforms out there, so you kind of have to shop around to see which is best and what you do. Debt and equity crowdfunding tend to have much higher fees involved. I think crowdfunder with community share offers charges about 5% plus all the card transaction fees.
They have to.
A platform
Yeah.
FX which charges a flat fee of about 5,000, sometimes up to £7,000. So that again depends how much you're raising, whether that's worthwhile or not. But there are so many platforms out there now. With community shares, it's a lot more limited. There's only 2 that you can use. But with other forms of crowdfunding, there's huge number out there.
So Glengarry, the one that's upcoming share offer with ethics is going to cost them 11 grand.
Really?
I mean, ethics are doing a lot, and obviously the benefit of using ethics or crowdfunder is
Yeah, it's got
access to
big
their
reach, and
database.
I've
So
watched it, so it's
yeah.
like, yeah.
like that cost actually kind of normally pays off, but I mean, it's mad sometimes how much there. Any questions from Zoom room? No, all good. Just to say, once Toby and I and Pauline have done our little bits about crowdfunding, shares and bonds, we're going to pull up a comparison table to kind of compare the 3 models, which I think is quite helpful. So community shares, I think most of you, I hope, have a fairly good understanding of what community shares are. So I think what I'm going to try and do is pull out the differences, particularly to donation and reward-based crowdfunding. So as you know, it is a way to raise money. It's a way to raise money for community organisations with an income generating idea. So that's the absolute essential point, first point. It's always our first question, is it, do you have a business plan, even a draft one? Have you thought about how you're going to make money here? Sometimes that's fairly standard and straightforward. So it's a pub, it's a shop, there's obvious kind of income generating models there. Sometimes if it's say a community hub, we did this with Bridgend, do you remember? We're like teasing out what the income generation might be, but it has to have some income coming in. We talk about it washing its face, so this isn't about generating huge amounts of profit, but there has to be that kind of circulation of money going on. So yeah, just to be super clear, this is an investment. So community shares are people investing into a business, not donating into a business. Different from reward and donation-based crowdfunding. So those investors, so hopefully your community investors, become shareholding members of the organisation. So this is something that you guys will be, are all obviously very, very familiar with. It's no different to how members of, say, a CLG or a SKIO works. They become members of the organisation. They're able to join the board, steer the direction of the business. The shares, so the kind of nominal share value, as we call it, the minimum share value in our DTAS model rules is £25, although we are considering changing that to £1 for various reasons, but one being accessibility in the current climate. We want to make sure that that minimum investment level is as accessible as possible. The technical term for community shares is withdrawable share capital in a community benefit society or a co-op. And what we mean by withdrawable is that the investor should get their money back at some point. Pauline will go on to talk about bonds and how that is much more of a strict, is that the right word? A stricter relationship with your investor in terms of when you might get their money back. With community shares, it's slightly more relaxed in that the board of that community benefit society have discretion to say in any 1 year, actually, no, we can't afford it. We're not going to offer any bonds. And on top of that, most boards put in caveats like in any 1 year, only 10% of the total share capital can be withdrawn. And no one can withdraw in the first 5 years of trading. So there's ways to make sure that you don't get 100 grand of share investment in and then 100 grand goes out the door sort of 5 years later. Community shares can offer, interest can be offered on community shares. So typically it's 2 to 5%. Not all of our share offers do offer interest, and we do tend to see that those can be successful as well. So in order to do community shares in the UK, you have to be either a community benefit society or a cooperative society. Both of those legal structures are regulated by the Financial Conduct Authority. And as I think most of you will know, we do have model rules, so templates in the way that DTAS has templates for CLGs or for SKIOs that groups can use to register a community benefit society. And Toby and I have now done lots and lots. The other two organisations that offer model rules that we use quite a lot as well are Plunkett. So in particular, if it's a rural shop or a rural pub, their model rules are maybe a bit more appropriate for that. Or if it's something that's kind of a bit more general that maybe doesn't quite fit the DTAS model, then we tend to use the Co-ops UK model rules, which are, I'd say, yeah, a bit more general and less specific than our rules. So that's community shares, and then you'll hear us talk about a community share offer a lot. And what we mean by that is simply that just means a time-bound campaign, so a time-bound marketing investment raising campaign. It's typically about 1 to 2 months, and that's when the group, so that community benefit society, has a target raise amount for a specific project. So 50k, we need to raise 50k to start up this community shop. We get asked a lot what community shares can be used for, and I think primarily they do tend to be used for purchasing assets, but importantly they can be used for other costs and revenue costs as well, and that's where they can actually come in quite handy. So something like SLF giving 95% of the purchase costs, shares can come in to do that final 5% plus the stock, the staff, working capital, etc. In a community share offer time-bound campaign, the community itself can set a different minimum investment level to what the rules has as standard. And that can be different for community investors and non-community investors. So what we've tried to push a little bit is that the community investors can always go in at the minimum investment level. So at the moment it's £25. But for non-community investors, so folks, and that this can be, you know, global, it doesn't just have to be the UK, and we try and put that a bit higher. So Glengarry Community Woodlands, their share offer is going to be £500 for anyone outside the community who wants to invest. And that just kind of really makes sure that the community have first dibs and that the local control is the majority and sort of baked in. Yeah, so we can, the rules again can factor in majority community control as well if needed for something like Scottish Land Fund, they require it. Yeah, that's community shares. I'll just do a quick case study and then you guys can ask any questions that you might have. I was trying to find something that's probably our most standard case study in terms of just trying to break it down and making it as normal as possible. So this is Crunchy Carrot in Dunbar. Has anyone been?
Yeah, that's my friend.
Is it? I knew you would know them. We have so many photographs of people standing holding vegetables in front of shops. Everyone always thinks that's a unique idea. And we're like, no. So this is Crunchy Carrot, which is on the High Street in the bar. Renamed the Community Carrot after the community took it on. So the story was that the community were offered the chance to buy the business. It had been a long-standing private business in the community, and the owners just wanted to retire, didn't they? They were they were done, they wanted out, but they didn't want to sell it to another private owner, so they offered the community the chance to purchase it. So Toby and I trotted down. That was a good visit, wasn't it? And we so we kind of worked with them on what their funding might be. They did get a SLF grant of 119k, so that was for 95% of building purchase. And as I was just saying, community shares were really useful and they were used to fund the 5% remaining plus the going concern. So the private owners got a little bit of money for the business, for the stock, refurb, working capital. And in 2019, they raised 65,000 in community shares, which I think is probably a fairly standard amount for a community shop. And they had 10% community shares, so they made it even more accessible than our standard £25 minimum share holding, and that was from 578 investors. So it was massive. We did so well. And the breakdown is quite interesting in that, well, quite interesting, but fairly standard in that about 80–90% of people do tend to go in at that minimum level. It's just kind of basic human instinct. You go, I'm going to support that project, easy, okay, £10 go. So we did encourage the community to identify who their sort of higher net worth individuals were in the community. I hate that phrase, rich folk. And to target them. So we did get some chunkier investors, maybe going in at about 5–10 grand as well. What I love about this one is that they call it a whole lot more than a fruit and veg store. So it is a shop, but they've since gone on since 2019 to develop the business, and they've got a weekly community meal using surplus product from the shop that doesn't get sold. And they also do after school cooking workshops with both kids using surplus food as well. I thought it was also quite a good example of how we work with Plunkett and CDS as well. So we have this partnership working with them that sometimes isn't fully clear. So, and this is where it worked really well. So the Plunkett Foundation were brought in to do the business plan development on the shop. So how the community will take on that shop and continue to run it well. And we also engaged the community in that process. And Cooperative Development Scotland were brought in to do the governance support for the group to set up the Community Benefit Society. And again, get that board and that community engaged in that process. And then Toby and I came in to do the share offer and everything with that.
So you didn't take Plunkett rules?
We did use Plunkett rules, yeah.
But Plunkett didn't have them with that.
So CDS provides the funding for that governance support, but a group can choose whatever rules they use. So sometimes groups come to us and use Plunkett rules, but it's CDS that provide the funding for that governance support. Any questions about community shares or about community carrot?
Is there a maximum amount that a community should accept in terms of the losing in the community shares? Because obviously if they're paying out interest, they're potentially gearing their business quite highly. So in a sector that's quite dependent on grant funding for that kind of course setup.
We tell them to set 3 different targets. So first you have the absolute bare minimum, and below that you can't go ahead with things. So in community carrot case, that was probably the 5% they needed to draw down the SLF grant. We would then have the kind of what's called the optimum share offer target, which is the amount that you've got a fully costed detailed business plan for. And then you've got the maximum, which is how many shares you will issue, which you should have a rough idea of how you intend to spend it. You should be able to say, you know, if we get this amount, we'll look at renovating the building, getting this new start, and have it, but it doesn't have to be fully costed in the same way. And yeah, we need to look at the business plan with them to make sure that that's not affecting the withdrawability of the shares, because if you issue 300,000 in shares, you need to generate 300,000 surpluses before you can return that money. So it does affect when people can get the money back, and you shouldn't issue more shares than you need to, basically.
I think there's a good point about the cost of it as well. So like 4% on £300,000 per year to come is a big deal. So yeah, that would also be factored into the financial modelling we do. And some groups actively promote withdrawals. So they'll say, you know, they even sort of map that out, particularly the big renewable energy initiatives, where they say over a period of, it's normally about 25 years, they actually want to pay back your share capital. But what we encourage groups to do is not to remove the membership from that. So say I've invested £5,000, I will take £5,000 minus the minimum investment level back. So that means I retain 1 share, I'm still a member, but I've got my capital, the chunk of the capital back.
There's a question from Laura. Maybe Laura, do you want to just unmute and ask a question?
Yeah, sure. I was just asking whether there was a cost to Plunkett support. And I think they have a membership program too, don't they?
They do, yeah. So Katie actually met with them last week, asked her to get a bit of an update. So she would be the best person to ask, but I believe it's 230.
Yeah, so I mean, whenever you register a community benefit society, there's a cost to registering it. In the case of the rules that we manage for DTAS, that's £200 paid to DTAS for use of the model rules. And then there's a fee to the Financial Conduct Authority, the regulator, to register those rules, which is usually £40, but it can be higher if they have to make any amendments. With Plunkett, it's a bit more expensive. So in the case of Community Carrot, to have Scottish Land Fund compliant rules, they have to make a few changes to Plunkett standard rules. It ends up costing about £650 in total, which includes a year's membership to Plunkett. It's sort of cheaper if you buy the membership because of the discounts they have. I think if you were to do it without any changes, it would be about 500 something, maybe up to £600. So their rules are a bit more expensive, but you do get the membership wrapped up in it usually.
Anything else on that?
Can I ask, is there a differential in your fee for DTAS members and DTAS non-members?
It's supposed to be, but we've never carried it through. So it's supposed to be £200 or £200 for members or CSS clients or cross clients and £400 for other.
Right.
But
I think that we've never had a case yet that we're not actively supporting the process. So they all kind of count as shares clients. I think it would be a bit weird if we were to give access to rules that we're not. We don't have a hand in.
we have to literally sign off the rules. So it's not like a group can go and use them and watch them with the FCA unless they forge one of our signatures. I think it's happened.
We did.
Yeah.
Well,
Yeah.
I mean, the FCA do not really
Hopeless.
check that
Yeah.
much. So we did have a society that registered using our rules, and we found out
Yeah.
well down the line.
But they shouldn't be able to use them without paying. Yeah. And it's a wee income generator for us. I think we've done about 12 registrations now, so not massive, but you know, a few grand it's coming through it.
Yeah.
Great. In time, not bad. So I'll hand over to Pauline now to talk to you about community bonds.
Okay, so I think that's it. Thank you. So basically, oh, put on my glasses again. So basically, I think what I'm going to do is I've listed a number of points here, but I'm going to really kind of focus on the ones that make it different from community shares. And I suppose the first of that is to do a community bond, you do not need to be a BENCOM. And that when we set up the SCF, it was particularly to bridge that gap between an organization that pre-existed with its own legal structure, scale, company limits by guarantee, kicks, whatever the structure is, and didn't necessarily want to actually create a new structure, a BENCOM, or didn't want to change its pre-existing structure to a BENCOM. So the way we set up, with the help of courts, okay, we set up a structure that actually, technically, they kind of use our BENCOM regulations. And when we talk about community bonds, technically they are what is known as a mini bond, but we obviously just call them community bonds. But in the case of the whiskey one, we call it a whiskey bond. You know, if you ever took, we're a customer of Hotel Chocolat, which is a private company. They did a chocolate bond way back about 8 or 9 years ago. So, you know, but technically they're a mini bond. So you don't need to have a BENCOM status. And that was always the intention. How do you raise money and without having to change a pre-existing legal structure? And the other big thing is there's no ownership or governance responsibilities. So these are not shares, which implies ownership. This is basically you are lending money to an organization for a determined period of time. And basically you don't own anything in it and you have no governance responsibility that comes with being a member of an organization or being an owner of an organization. Like community shares, you have to produce a community bond prospectus. And again, that has to be honest. It has to lay out what the money is going to be used for. It has to lay out when you're going to get your money back, what the percentages, the eligibility criteria, what the minimum bond sum of money is, what the minimum investment is. Really, I suppose the reason that we try and unlike some existing organization, even in terms of ETHEX, they may already have pre-existing investors. we start off with no investors for your organization. We want it to come from your community. So we don't have a load of investors waiting saying, oh, we'll invest in this renewable. Actually, there's nothing there until we start a campaign. Bonds can't be sold. Technically means that there's no secondary market for bonds. And the exit strategy for investors is actually a fixed repayment date. So a 10-year bond, a 5-year bond, a 3-year bond, 7-year bond. And that is determined not by us, because these are all very bespoke. That is determined by the project that we're working with. You know, we want to extend the theatre, so but we won't get any customers for 2 years. So, you know, you're not going to be paying income back for 2 years. So you might then have a bond based on when you're starting to generate income. But there is a fixed maturity. So if you say 5 years, at the end of that 5 years, you have to have the money and the interest available. Suitable for small and large finance. Again, we don't prescribe that. We don't say, oh, we don't deal with anything less than 10K. We'll do whatever is needed, basically, because it's your community, it's your needs. It's nothing to do. We're just there to make it happen and to assist you to make it happen. It's suitable for most type of economic development. So far, we have done, we're doing growth for an organization who want to grow the organization, grow their business. We have done it for renewables. We have done it for a new development. So again, we don't prescribe what its functions or what we only use bonds for. It's entirely down to, if it's the most suitable vehicle for your organization, then that's basically the way we go. We do charge a fee. We do get money from the Scottish government, but like all organizations, we come under some pressure to actually charge. But we have to be very mindful that the more we charge, the more the cost of money is to that organization. And this is about affordable finance. This is about money that an organization can afford. And we know that in the sector, affordability, if you strip out credit unions and strip out housing associations, affordability and profitability is 4%. So we're not talking about charging £11,000 in fees, but on the other hand, we have an obligation to get some of our costs back. So we do charge a one-off fee for doing the bond. You can do more than one bond, and the case study that I'm going to go on to will actually demonstrate that. And there's nothing to stop you offering a reward and therefore creating a new client base. So, you know, if you're producing bags, you can say for every investor will get a specific bag as a reward. And again, it's just come back to what Toby says, you can mix and match some of those things. And I suppose the other thing that I should have put up here for this morning, which is that there's nothing to stop community shares and community bonds. The whiskey one was going to be shares and bonds. And equally, there's nothing to stop it being blended. So you coming back to the community shares, so you get 95% and you're looking for 5%. So it's a vehicle that's there basically to help you raise money if you cannot do it in any other way, particularly if you don't have the legal structure to do it in another way. So the case study I'm going to do that I was asked to do is the Linlithgow Solar for a number of reasons. One is this was actually a project that was referred to us from DTAS. The organization is a pre-existing organization. They didn't want to change that structure. They were very comfortable that they had quite a large membership. They didn't want to grow that membership. And they wanted to do renewables. So basically, we did a pilot with them. And this was about going out to local clubs, sports clubs. And the community themselves had an objective. The name is in the clue, Linlithgow. It's the Linlithgow Community Development Trust. They have an objective, they've a long time being transition town, and they want to do something about energy efficiency within the town and make the town energy neutral, carbon neutral in relation to energy. So they went out and we did a pilot with just one sports club who were interested in putting renewable panels on the roofs, but didn't actually have the capital to do that. And so Linlithgow and us, we did a bond offer. And Linlithgow raised the money, we raised the bond offer. And actually what happened is a PPA, a power purchasing agreement, was put in place between Linlithgow Community Development Trust and the sports club. So once that money is paid back, then Linlithgow will actually start generating an income through the PPA. The other interesting thing about this was the second bond offer we've done. We offered 3 maturity dates, a 5, a 7, and 11 year. And we incentivized with the interest rate, the longer term. So you got less of you stayed in for 5 years, a little bit more of you stayed in for 7, a bit more of you stayed in for 11. And I have to admit, administratively, it's a complete nightmare. I don't do that anymore. If somebody asks, but I don't bring it to their attention anymore, because it is a bit difficult. And we also offered interest we paid annually and interest we paid at maturity, and we don't do that anymore. It's a nightmare to manage that. So basically, it was a learning curve in terms of that. But interestingly enough, we no sooner got the panels on the route when other sports clubs started coming forward and saying, actually, we'd like to be involved in that. So we very quickly did a second bond offer. And actually something like 46% of the people who invested in the first one came in for the second one. And the actual average sum of money invested went up as well. It was like once people in the community saw the panels, it was like they got confidence. There was something about their ability to get confidence from the panels. So we did a second one with them. And potentially now there's going to be a third one. So there was a lot of, so I think there was a lot of learning for us in that, in the sense that we learned, maybe what not to do in terms of making it too, how should I say, too complex for investors. But we also learned that actually there's a big issue in terms of supply of money, which is ordinary people who don't consider themselves to be investors. How do we encourage people to think of themselves in that way? How do you use the language that the FCA says you have to use, like your money's at risk and all the other stuff, without frightening people? How do you make the supply and the demand balance up and genuinely create, a network of citizen investors within your community? I think that's probably all. Oh, hold on. I've got a few other things to say, sorry. Coming back to again what Morven and Toby said, none of these things will happen without a really good social media campaign. And like shares, it is a campaign, there's a set period, it opens, it closes, you have to raise so much money. If you get 90%, then we're willing to extend, if not, then we don't. But we've had one failure, and that was to do with social media, because the fact is they really underestimated the extent to which they needed a dedicated resource to make that happen. And so that was a learning curve for both the organisation itself. And finally, the other thing is we've actually got a bond guarantee through the National Lottery. So if a community is raising money in a particular SIMD area, then we can guarantee that Mrs. Smith and Mr. Jones will get their money back, irrespective of what happens in the project. So if COVID hits again, and you're in a community that don't have a lot of spare financial capital, then basically we can say you're going to get your money back, and hopefully that gives them a bit of confidence. But it's not applicable to all communities. They're very strict about who they allow us to use it and what communities we can use it. And I think that's fair. Some communities can afford to lose, and some communities and some people can't. And finally, organizations can actually take a bond as well. So a local supplier, we give them a share certificate, but it's got no value other than promotional marketing too. That's it.
Thanks, Colleen.
Oh, it's not necessarily in the sense, it just depends. I tend to go from the point of view of what can you afford to pay? And as long as the only competition is the bank, because let's be honest, we're talking about Mrs. Smith, they don't have investments. You might have a pension, but nobody understands pensions anymore. So, you've got some money. Well, after the last couple of weeks, they've been slashed. Anyway, but we've got that situation whereby, so it's very much about, well, if Mrs. Smith has £200 and she'd like to invest it, she's only getting 0.25%. So we have done interest rates as low as 0.85%. And the most we've done is 2.5%, which is the one that's going on now. So we don't have a prescribed sense of that. We want it to be attractive, but if you know your community and you know that your only competition is the ISA that they're getting maybe 1% on, then you can actually, and the affordability of the project, obviously. So you're saying 7%, and our rules specifically state that we cannot prioritize investor returns. So even if somebody came to us and said, we can give you half the money, but we want 7%, and the project actually can't afford 7%, we couldn't accept that. We can't prioritize investment returns. It has to be the affordability to the project of the money. They did get grants as well, we have to do all this stuff.
But they had a balance to it. So how does that bit work? So what's the money invested in? So I mean, you've got the grant appears to do the majority of it, and they had a little bit. They had to use to buy the panels.
Yeah.
The other 5 buildings. So
It bought the panels.
so and then where does so this. So I think it was 2%.
No, for the first round, it was 0.85%, 1.17%, and 1.75%. And that, given that this was before COVID, interest rates were 0.01% is something ridiculous like this. So actually, 0.85% is still an attractive proposition if all you get is 0.01%.
Yeah.
An established development trust didn't want, but wasn't a bank from.
So can I just say that questioners cannot be heard?
Yeah,
By-
this is not working.
So you have to be really loud.
So if an established development trust that isn't a BENCOM structure doesn't want to change, but wants to raise, this is why bonds would be attractive
Yes,
to them
yes, they can raise money through our BENCOM.
without changing the structure.
Without
and
changing the structure.
And if they don't want more members.
And if they don't want more members, yes, say
they
they
don't
have,
want that ownership. Yeah.
or even something like they actually feel that they can't raise that money through their existing share owners. Maybe they've already gone out 2 or 3 times and there's a sense that we really can't go through share owners anymore, because the local people, they've already supported us through 1 or 2 share offers. Then maybe we're looking for a wider pool, and because there's no ownership or governance, they can come from anywhere, basically.
And given it's underwritten for disadvantaged communities. it's
Yes,
potentially
yes.
very attractive.
Yes, and I'd like to see that model be new. I'd like to test that because I think there's an appetite from other funders to look at this if we can evidence that actually it empowers the community to be involved. And it's not even that, when you're talking about an SIMD area, it's not even that you're necessarily talking about all the residents, but there are resources in those communities. There could be a sub-housing association, there could be a parade of shops, and it's about encouraging where the money is, that and organizations and people that want to see that community succeed. So it's not necessarily, and because there's no ownership, the whole thing about ownership isn't an issue. So even if you only get 5% of the money from local people when you're guaranteeing that, if the rest of it comes from the dentist and all the other suppliers, then it's still from within that community and still money is still spent in that community.
We're running out of time a little
Oh.
bit, but no, not your fault, Pauline. It was my bad from the beginning. So if you guys take anything away from this session today, I think this is probably the most useful resource. So we've tried to kind of put everything that Toby, myself and Pauline have just said into a comparison table. So looking specifically at organizational considerations. So, a development trust, what they should consider, and then what the investor or the giver should consider. So just if everyone's still fine, just to give us another 5 minutes, we'll maybe just focus on this, and Toby, Pauline, just jump in. So legal structure is a really important point. So with reward or donation-based crowdfunding, it's not required, or you can pretty much use any legal structure. With community shares, as I said, you have to be a BENCOM or a community benefit society is the longer term, or a co-op, although we haven't worked with a co-op yet in the 8 years that we've been doing this. For community bonds, yes, you have to be a BENCOM, but as Pauline said, she is the BENCOM. So SCF is the BENCOM, which means that a development trust can come along and use Pauline's BENCOM to raise the money. In terms of how admin heavy it is, I think we'd be lying if we said that bonds and shares doesn't involve a lot of work. So this is what Toby and I do pretty much every day. It's business planning, it's financial modelling, making sure that that is watertight because it is an investment. And particularly because it's Mrs. Smith that's investing in your project, and she's maybe has never done this before, maybe doesn't have a huge amount of savings. So it's even more important, in my opinion, to get that bit right. Equally, donation reward-based crowdfunding is not admin light, I would say, and particularly that Scotland the Bread case we worked with, that was months and months and months of work to raise 26k. So we kind of push that message as well to groups. In terms of the investor and the giver, so in terms of membership, so you do get membership if it's community shares, but you don't if it's community bonds or donation reward crowdfunding. Investor returns, so no for crowdfunding. Community shares, yes, but with those caveats that I talked about earlier, in that the board of the Community Benefit Society always have control and discretion over that. And the community bonds, yes, the investor does get a return, and that is set, as Pauline said, and pretty much a guarantee unless the business flops, would you say?
Yeah. To keep it,
Um,
we work very closely with them to make sure that
Okay.
the finances are there by the exit maturity date.
And by returns, that's maybe not so clear to maybe change that wording. What we mean by that is the withdrawabilities of getting your initial money, your
Capital.
back, getting your capital back. And then on top of that, whether you get any interest on that capital. So you don't with reward or donation-based crowdfunding, and with shares and with bonds, it's optional for the group whether they want to offer that. It's much more likely that you would with a bond offer. And with community shares, there's a big spectrum, and again, it's at the discretion of the board, whether you can afford to pay that each year.
Can I just, the optional for interest received by investors, I would say that's yes, because I'm interested in encouraging people to think about where they spend the money and trying to distinguish, because a lot of people still think that you're talking about a donation. And I think the concept of giving somebody an interest actually changes the mindset about what they're doing with that money. So for me, it's really important that we've never done one that we haven't done an interest, because as I say, it's a cultural thing in terms of trying to change people's mindset. It distinguishes it from being a donation kind of process. Although like community shares, if people want to donate at the maturity date, then they're more than welcome to do so, and we give them that option. But at the beginning, we're trying to get people to think about money and investing it locally. And I would also just say, in terms of the organization considerations, like, when Morgan showed me this, I was thinking in terms of SCF, but I have to admit, in terms of the frontline organizations, the legal structures of those organizations, I do think there's a fair bit of work that I think is perhaps, especially around social media. And I do think that perhaps that's not, my learnings, I really have to stress just how important that is, because there's a lot of competition out there for all of these democratic finance, and they have to have, and we do help them with doing a social media strategy. But, at the end of the day, it's their communities, and they have to kind of work. I don't know what the best messages for them. So
I think it's the added value that we stress with that. So, I mean, I've just spent a year working with Glengarry, and we've got the business plan and the financial model sorted, and that will hopefully raise the 250,000 that we need. But they will then be able to use that business plan to go and attract other funding in. They now have a solid financial model for their board to work with. It's been a huge learning experience for the whole board. And also with that marketing stuff and the social media stuff, once you've got those people aware of the project, they are then your community. So it's a massive community building exercise as well. So it seems a lot of work, and it takes a lot of time and a lot of money, but actually, not a lot of money, but to get the money in. But actually, the benefits are much wider than just the raise that you get.
I would agree with Morgan. It's as much an economic development process. They end up with a better business plan. The due diligence has picked out the weaknesses of their risk strategy, the social media campaign. So going forward, whether they go for grants or other forms of investment, or even just bulk standard loans, I think the whole process actually results in a more robust organization, and they have a more understanding about their figures and their finances, certainly. Yeah. But yes, so I would agree with Morgan on that.
one kind of investor incentive that we've not really spoken about yet is that most share offers, and I think most bond offers, tend to be eligible for investment tax relief. So there's 3 schemes currently. There's social investment tax relief, which may not have that long a future, but there's also the enterprise investment scheme and the seed enterprise investment scheme. The first 2 offer 30% of the investment. So if somebody puts in, say, £1,000, they immediately get £300 back as they break off taxes. Seed investment scheme is 50%. With the 2 EIS and SEIS, there's also a kind of safeguard. So if your investment fails, you can essentially put that money into another comparable investment and can keep that investment rolling, so you don't always lose the money. So tax investment in that sense.
It's a big draw, isn't it? For particularly
Yeah.
those people that are putting in
Big
thousands. Yeah, yeah. Not all projects are eligible, so there's certain things like renewable energy, property development, leasing that are not eligible. So some of our groups have not been able to go for it, but I would say a lot have.
Yeah, well, SCF is eligible for community investment tax relief, which is CITR. We hadn't thought we would have went for a CITR accreditation by now, but with COVID and everything happening and Brexit and the FCA being really swamped with banks trying to get all this new registration. Basically, we just felt we're going to put it off for another year, but we would hope to have CITR, which is 25%. I know the SITR is under review, but I'm not getting any sense that the CITR is under review. So if we manage to get that, then definitely I would be urging interest rates to be as low as possible, because you will make your money back on the CITR or the SITR in terms of your return. So there's no reason why we should be asking, or any investor should be asking for this, unless they're investors in that kind of big sense of the word. But normal people, there's no reason why your tax relief from your investment shouldn't actually give you much better than what you're getting in the bank. So you have to play that into when you're looking at how much interest you want to encourage to pay.
We're 10 minutes